Today, we're going to do something a little different. We're popping the hood on a really unique investment engine, the Apex Hybrid Long Short Fund. So, join me for a quick mechanics tour to see exactly what makes this thing tick. Okay, so let's start with a problem that I think every single investor has wrestled with. You obviously want your money to grow, right? But at the same time, you're always kind of looking over your shoulder, worried about what happens when the market takes a nosedive. It's the classic dilemma. How do you play offense and defense at the exact same time? Well, it turns out some investment strategies are actually engineered to do just that, to try and navigate both the good times and, the not so good times. And that's really what our mechanics tour is all about. We're going to get our hands a little dirty and really understand the inner workings of this particular engine. First up, we need to tackle the main concept that gives this fund its name. It's a two-way strategy, and it's all built around these two little words: long and short. So let's start with the official jargon, just to get it out of the way. It's an interval investment strategy. In plain English, that just means you can't trade it every single day like a normal stock. You buy or sell at specific set times. It invests in equity and debt, and here's the key part, it uses limited short exposure. Think of it as a fund with a pretty special tool in its kit for playing defense. And this right here is the most important part. A long position, that's what we all think of as investing. You buy something, you hope the price goes up. Easy. A short position is the total opposite. You're basically placing a bet that an asset's price is going to fall. Now, this isn't just about being pessimistic. It's an incredibly powerful tool for hedging or protecting your other investments if the whole market starts to drop. All right, now that we kind of get the long and the short of it, pun intended, let's move on. It's time to see how this engine is actually put together. We're going to deconstruct the portfolio piece by piece. So this chart shows us the engine's main parts. You've got directional equity. Think of that as the gas pedal, aiming for growth. Then there's hedge equity. This is more like the suspension system. It uses tools like arbitrage to try and smooth out the bumps in the road. And finally, you have fixed income. That's the chassis, the solid conservative frame holding it all together. And here we can see the specific job that each of those parts has. Unhedged equity, it's there purely to capture that upside when the market is doing well. Arbitrage tries to profit from tiny little price differences, which is a much more market-neutral approach. Fixed income gives you that steady, stable base. And then you've got these special situations. These are tactical plays on specific events, like an IPO or a merger, that hopefully don't depend on which way the broader market is heading. Okay, now for the fancy tools, derivatives. A pair trade is kind of like betting on which of two very similar race cars is going to win, not just on how fast one car goes. Futures and options are like putting a deposit down to lock in a price for later. It's a way to manage your risk. And a straddle is even cooler. It's basically a bet that the market is about to get really bumpy, but you don't care which direction it moves. Okay. Any good mechanic knows you can't just talk about horsepower. You have to do a full safety check. So let's be real and talk about the risks that come with a strategy like this. Before we dig in, let's see what the fund says about itself. On their own 5-point scale, they label this strategy a risk level 2. Now, that suggests a pretty strong focus on preserving capital, but let's be clear, it definitely doesn't mean there's no risk. So, here are the main warning lights on the dashboard. Liquidity risk just means some of the things the fund owns might be hard to sell in a pinch. Default risk is pretty simple. What if someone they loaned money to doesn't pay it back? Price risk is about how outside forces, like interest rates changing, can affect the fund's value. And finally, volatility risk is just the honest truth that sometimes the market just goes wild for reasons nobody can predict. But here's the crucial part. For every one of those risks, there's a management strategy. To fight volatility, they diversify. To keep everything balanced, they are constantly monitoring their positions. To control the risk from those complex tools, they stick to high-quality instruments. And maybe most importantly, this is an actively managed fund, which means there's a team at the wheel constantly making adjustments based on road conditions. So we've seen the engine, we've done the safety check. The last question on our tour is probably the most important one. Who is this car actually built for? What does the ideal driver look like? Well, the fund's own paperwork gives us a pretty clear answer. It says this product is for investors looking for long-term capital appreciation. And the key words there are long-term. This is not a get-rich-quick vehicle. It's designed for someone who is patient and thinking years down the road. And to really put it in perspective, let's compare it to a more traditional fund. A normal equity fund is basically a one-way bet on the market going up, which makes it super vulnerable when things go south. This hybrid fund, on the other hand, is built to be more flexible. It aims for what's called risk-adjusted returns by having that shorting ability in its back pocket as a defensive tool. So, after this whole tour, what's the one thing you really need to remember? With any complex machine like this, transparency is everything. It's so important. Before you even think about getting in the driver's seat, you have to read the owner's manual. That means looking at the fees, understanding the rules for getting your money out, all of it. And that pretty much brings us to the end of our mechanics tour. We've seen how this strategy tries to play both offense and defense, how it aims for growth, but keeps some protective tools ready for when things get rocky. So the final question, really, is for you to answer. Could a strategy that's built for all seasons be the right fit for your own long-term journey?